bring economic forecasts. I will give the floor immediately to Commissioner Gentiloni.
Thank you very much. Good morning. Let me begin, as usual, with the key messages emerging from our forecast. First, compared to the previous one, the winter forecast, published the 10th of February, growth in the EU economy is revised lower and inflation higher. We now forecast the EU economy to grow by 2.7% this year, before slowing further to 2.3% next year. For 22, this is 1.3 percentage points lower than projected in February, so one of the steepest between forecasts downgrades. Annual inflation is expected to hit an all-time high of 6.8% this year and to fall to 3.2% next. Second, the war has clearly exacerbated the headwinds that were previously expected to gradually fade. These include the sharp rise in commodity prices and the aggravation of the existing supply-side disruptions, as well as the emergence of new ones, for instance, in transport and logistics. Third, a strong and improving labour market, decreasing household saving rates, favourable financing conditions, and the full deployment of the RRF are set to support the economy. Fourth, deficits and debt ratios are forecast to decline this year and next. Governments, as you know, are in the process of phasing out the COVID-19 universal emergency support, and the cyclical rebound in revenues is in full swing. So the aggregate budget deficit in the EU should decline from 4.7 in 21 to 2.5 in 23. The debt to GDP ratio is projected to continue on the downward trend, falling from 89.7 to 85 in the EU. It's higher in the euro area. As you know, it was 97.4 and in 21, and it will be 92.7 in 23. Fifth key message, uncertainty to the outlook has clearly increased and risk has tilted to the downside. And are predominantly these risks related to the duration of the war. Given the unprecedented nature and size of the shocks affecting the EU economy, our forecast baseline is underpinned by several technical assumptions that I want to recall. First, the extremely elevated geopolitical tensions are not expected to normalize before the end of the forecast horizon. These are our assumptions. No major disruption to the supply of energy commodities to the EU economy occur in the forecast horizon. Again, this is the assumption, in line with the customary no policy change assumption, as by the end of April, which was the cut-off date of this forecast, no such disruptions were observed. Recognizing elevated risk around this baseline, the forecast is accompanied by a model-based scenario analysis that simulates the impact of higher energy commodity prices, as well as an outright cut in gas supply from Russia. And I'll come back to these model scenarios at the end. So the real growth projections for the EU this year and next have been revised down under the heavy impact of Russia's invasion. Still, the European economy is expected to continue expanding as residual support from the post-pandemic reopening and the strong policy response to the COVID-19 shock still support growth. I'm conscious that the growth projection for this year 2.7, may appear benign relative to the size of the shock generated by the war. However, out of this figure, as much as 2 percentage points is due to the exceptionally strong rebound of last year. Net of this, the so-called carryover effect, within-year growth for 22 has been cut from 2.1 to 0.8%. In both 22 and 23, domestic demand is expected to keep driving growth. In particular, private consumption and investment are set to continue growing, albeit at a weaker pace than previously expected, of course. Both private consumption and investments are expected to be negatively affected by high inflation, uncertainty, and aggravated supply bottlenecks. At the same time, consumption should continue benefiting from the post-pandemic reopening momentum, a buoyant labour market, lower accumulation of savings, and fiscal measures to offset rising energy. Investment is set to be supported by the full deployment of the RRF and the implementation of the accompanying reform. Finally, next exports are projected to provide only a marginal positive contribution to growth, as both export and import volumes slow down. Inflation. Inflation has been picking up momentum since early 21. In the euro area, it rose from 4.6 year-on-year in the last quarter of 21 to 6.1 in the first quarter of 22, and then further to 7.5 in April. This is the highest rate in the history of our monetary union. This acceleration has been driven by the surge in commodity prices that lifted energy and food prices inflation to multi-year highs. At the same time, inflationary pressures are broadening to other categories of goods and services, and this is well visible in the continued rise in core inflation, which eliminates energy and unprocessed foods. So inflation is expected to peak at 6.9% in the euro area in the second quarter of this year and gradually decline thereafter, largely reflecting the commodity price assumptions which are derived from market futures. On an annual basis, inflation in the euro area is projected to reach 6.1 in 22 before falling into 2.7 in 23. This is for the euro area. Core inflation is forecast to be above 3% in both 22 and 23, though falling gradually in 23. Recent inflation readings and the inflation outlook for the next 2 years differ widely across member states. The range is from 4.4 in Portugal to 12.5 in Lithuania, with 4 member states with inflation below 5% and 5 above 10%. In 23, the range is expected to narrow considerably between 1.8 of Spain and 7.1 in Poland. So the widening will decrease in 23. Inflation expected in Central and Eastern Europe is visibly higher than in the rest of the Union. Inflation differentials largely reflect dispersion in retail energy price developments, as well as the importance of energy and food in national consumer baskets. The main hit to the EU economy comes through commodity markets, primarily surging prices of energy, but also food commodities. Sharply rising commodity prices are depressing household purchasing power and raising production costs for firms while fueling inflation. The war is also weighing heavily on global activity and trade, reducing external demand for EU exports. First, directly via the fall in trade with the region at war, but also through a major terms of trade shock and exacerbating shortages and various supply-side bottlenecks. Financial markets are also an important channel of impact. The war triggered a repricing of financial assets, tightening of financing conditions, and increased prospects of accelerated normalization of monetary policy. Finally, the war has dramatically raised uncertainty and severely dented household and business confidence, just as most of the EU was shaking off the pandemic blow. So now the main effects come via commodity markets. Supply uncertainty in the aftermath of the war has brought renewed upward pressures on commodity prices. The increase was broad-based and affected metals, agricultural commodities, but predominantly fossil fuels, gas and oil. Higher energy and food prices reduce household purchasing power, especially for lower-income families, and this weighs on consumption and dampens domestic demands. They also increase production input costs, raising producer price inflation across the economy. In the case of energy-intensive industries, this may lead to serious disruptions in the production process and result in shortages in certain markets. It is important to stress that the forecast uses the indications coming from market futures curves to project developments of commodity prices and does not factor in large-scale interruptions in their supply. The shock waves of the Russian invasion of Ukraine are reverberating globally. The direct impact is related to the collapse of activity and trade across the eastern neighbourhood of the EU. Indirectly, negative spillovers to global demand come from the surge in commodity prices, disruption in the supply of raw materials and intermediate inputs, aggravated transport bottlenecks, and tightening financing conditions. Lockdowns in parts of China further weaken the outlook for emerging Asia, with global ramification through amplified disruption to logistics and value chains. Reflecting these headwinds, the growth forecast for the global economy in 2022 has been downgraded by 1.3 percentage points compared to the autumn. So global GDP is now expected to expand by 3.2% in 2022 before picking up to 3.5% in 2023. Global trade has been revised down even more. Following a very strong rebound in 2021, the volume of global imports of goods and services is now forecast to grow by 4.9 and 4.4 this year and next year. This is 1.5 percentage points lower than in the autumn for this year. The labour market entered 2022 on a strong footing. The EU economy last year created more than 5.2 million jobs and attracted nearly 3.5 million more people into the labour market. In addition, unemployment at the end of 2021 fell below previous record lows. Employment in the EU is projected to grow by 1.2 this year, though here too the annual growth rate is lifted by the strong momentum in the second half of last year. People fleeing the war in Ukraine to the EU are expected to enter labour market only gradually, with tangible effects only from next year. Unemployment rates are forecast to decline further to 6.7% this year and 6.5% in 2023 in the EU. And in the euro area, unemployment is projected at 7.3% and 7%. This good employment news is tempered by the fact that in 2022, purchasing power is set to decline in real terms, as wages are not projected to keep up with inflation. An additional tailwind to growth will come from the decline in the household saving rate. Following a large accumulation of savings during the pandemic, households are now expected to devote more of their disposable income to consumption. Public investment is expected to increase over the forecast horizon, driven by the EU funds and in particular by RRF. Beyond public investments, RRF grants are largely used to cover capital transfers and current expenditures. The total projected absorption up to the end of 2023 amounts to some 1.3% of EU GDP. All EU economies are expected to continue growing over the forecast horizon. Following the uneven rebound from the COVID-19 crisis, the effects of the war in Ukraine have extended the list of factors explaining uneven growth outcomes. 7 member states, including Germany, Spain, and Italy, had not reached their pre-pandemic output level by the end of last year. A few words on the largest EU economies. The fallout of the war in Ukraine and COVID-19 related lockdowns in some of China's industrial hubs are hampering economic activity in Germany. Following subdued growth at the beginning of this year, Germany's GDP is expected to slightly contract in the second quarter. The German economy is expected to return to growth in the third quarter. Overall, the GDP is projected to grow by 1.6 this year and 2.4 next year. In France, following stagnation in the first quarter, GDP is expected to increase in the second. Services are set to benefit from the full easing of sanitary restrictions, while industry shows signs of resilience. So real GDP is forecast to grow by 3.1% in 22 and by 1.8 in 23. For Italy, the short-term outlook remains subdued, as the war has dented economic sentiment and exacerbated existing obstacles to growth. Still, real GDP is projected to increase by 2.4 this year. Next year, growth forecast is at 1.9, supported by RRF-financed investment. Spain is forecast to maintain strong growth this year, although the momentum should ease markedly in the second quarter. RRF investments and the recovery of tourism are set to support growth. So GDP is projected to grow by 4% in 22, before easing to 3.4 next year. Lastly, Poland entered 22 on a strong economic footing. A fall in sentiment, a collapse in trade with Russia and Ukraine, and increased inflation weighing on purchasing power are set to decelerate growth in the short term. Overall, the economy is forecast to grow by 3.7 this year and by 3% next year. The general government deficit, coming to public finances in the EU, is forecast to fall from 4.7 in 21 to 3.6 in 22 and further down to 2.5 in 23. This trend reflects the unwinding of fiscal measures, as I've said before, taken in response to COVID-19 and improvements in the cyclical components of the budget. The number of countries with the deficit exceeding 3% of GDP fell to 15 in 21. Under the no policy change scenario, it is projected to rise to 17 in 22 before falling back to 11 in 23. The additional costs in 22 related to measures to mitigate the impact of high energy prices that we measure in 0.6 of GDP for the EU, and to deal with the humanitarian crisis provoked by Russia that we measure in 0.1% of GDP, are not at the moment enough to outweigh these factors. I mean at the moment because we factored in what was decided until the end of April. Overall, these developments imply a supportive stance in 22, followed by normalization, so a broadly neutral, in 23. The debt to GDP ratio for the EU as a whole is set to decline from 89 to 85%, from 21 to 23. This is the EU, and as you know, in the euro area, the level is higher. In conclusion, the risks related to the unpredictable evolution of the war and of energy markets dominate the risk balance. And this motivates the model-based scenario analysis that I will discuss in the next slide. Strong inflationary pressures also come with increased risk to financing conditions in the EU and globally. This includes a stronger than currently expected rise in interest rates that could trigger a correction in the valuation of financial and non-financial, for example, housing assets, burden the banking sector, and reduce the availability of credit. These are risks. The unwinding debt crisis in China's real estate sector continues to pose domestic risks with large negative spillover to the rest of the world. On the positive side, domestic demand could prove more resilient to increasing price if households were to use more of their savings for consumption. Furthermore, investments fostered by the RRF could generate a stronger impulse to activity. But, as mentioned earlier, our baseline forecast is accompanied by a model-based scenario analysis that simulates the impact of higher energy commodity prices, and this is the adverse scenario, as well as of an outright cut in gas supply from Russia, and this is the severe scenario. In this latter, GDP growth rates would be around 2.5 and 1 percentage point below the forecast baseline in 22 and 23, while inflation would increase by 3 points in 22 and more than 1 in 23, above the baseline projection. Under both of these scenarios, within-year growth would be in negative territory. To conclude, Russia's unprovoked invasion of Ukraine is causing untold suffering and destruction, but is also weighing in Europe's economic recovery. Last year's strong economic rebound will have a lingering positive effect on growth rates this year, but this should not detract from the impact that the war is having on our economies. Even if the strong policy response deployed during the pandemic has boosted our resilience. Our forecast is subject to very high uncertainty and risks, and other scenarios are possible under which growth may be lower and inflation higher than we are projecting today. In any case, our economy is still far from a normal situation. Now I'm looking forward for your questions.
Thank you, Commissioner. So please raise your hand, announce the media you are working for, and I will give you the floor. The first question here.
Hi, Commissioner. Juan Sanemelando from El Español newspaper. So I have some questions on Spain. Your forecast for this year is somehow lower than the one published by the Spanish government only a week ago, and you're saying that Spain won't recover the level, the pre-pandemic level, till the third quarter of 2023. So I would like you to explain why this forecast. And my second question, in the report, you are talking about the risk of the indexation of pensions for the deficit. So if you could elaborate on that as well, I would be very grateful. Thank you.
Yes, thank you. Thank you for your question. Well, as I said, the growth path that we forecast for Spain is considering the circumstances and the other major European economies quite strong. We have a 4% growth for 22 and 3.4 for 23. And this is connected to the positive impact of very early implementation of some of the measures connected to the RRF, and of course the reopening of the economy, and in particular of tourism. As far as the impact of the pension reforms is concerned, we have a second payment request coming from the Spanish government, and this includes a milestone concerning the maintenance of purchasing power of pensions and the alignment of the effective retirement age and the legal retirement age. So we will assess this on the when we assess the second request. Of course, this is in compliance with the European Council decision. Spain has also committed to implement a package of measures that will ensure that the pension system is fiscally sustainable. And this is what we will also assess in the coming period, because this is connected to the fourth payment request from Spain.
Thank you. Yes? Second floor.
Thank you. János Aman from Euractiv. Commissioner, from a point of view of the employment and unemployment, this is one of the best economies that there has been in decades, I'd say. What are the economic learnings, or the learnings for the EU Commission, or that the EU as a whole should take from these figures?
Well, I would say first, I think we were right in protecting jobs. You may remember that this was one of the first measures that we took at European level, what we called the SURE mechanism, that was decided in April 2020. And this, I think, this decision, which was very important for countries with more limited fiscal space, but all European member states, also those not using this mechanism, were using short-time work schemes or similar. So protecting jobs was extremely important in the period of the crisis, and then phasing out these measures gradually was also helpful. Then we have a lot of changes in the labor market. I would not present the labor market as perfect, because in several countries we have a mixture of shortage of labor in several sectors, and still unemployment, especially in the younger generation, in other sectors. But overall, you are right. The general picture is very positive. it confirms that it was right to protect jobs during the storm and then to gradually phase out this protection after the storm. Now, of course, we will face the problem of how the reduced purchasing power will affect workers, and this is, I think, one of the big challenges of the couple of years ahead of us because of inflation.
Yes, please.
David Carretta, Radio Radicale, in Italian, if I may. Commissario, due domande. La prima sull'Italia. Malgrado deficit e debito stiano scendendo, nelle previsioni scrivete che rimangono a livelli alti. A suo avviso c'è spazio fiscale per altre misure di sostegno a famiglie, imprese, alla crescita, oppure serve prudenza? La seconda domanda, se vuole rispondere in italiano oppure in inglese, riguarda la clausola generale di salvaguardia. 7 Stati membri non hanno raggiunto a fine 2021 il livello di attività economica pre-pandemia. 1 non lo farà nemmeno, se ho letto bene, alla fine di quest'anno, ed è la Spagna. Ci sono tutte le incertezze, c'è lo scenario al ribasso in caso di taglio del gas. Ritiene che ci siano le condizioni per confermare ciò che era stato indicato all'inizio di marzo? Grazie.
Sì, grazie. I'll answer in Italian to the first and in English to the second. C'è spazio fiscale per ulteriori misure di supporto, con prudenza, certamente, ma lo spazio è collegato, credo, alla capacità che il Governo ha dimostrato in queste settimane, in questi mesi, di collegare misure di supporto che devono essere mirate e temporanee a delle fonti di entrate, il che è stato fatto con tagli temporanei di alcuni programmi e con misure di tassazione straordinaria sugli extra profitti energetici. Se queste misure invece venissero prese con, per esempio, scostamenti di bilancio, io penso che la prudenza sarebbe meno considerata. Ma il Governo ha più volte sottolineato di condividere questo punto di vista. As far as the General Escape Clause is concerned, we will, as always, make our proposal of prolongement or deactivation with the spring package that we will present next week.
Commissioner Maria Psara would start with Greece. A question on Greece, of course. For Greece, you mentioned that the emergency fiscal measures are due to expire in 2022, and the primary surplus is expected for 2023. Given all these difficult circumstances, will you insist on primary surpluses around 2% for the next years during the negotiations that I suppose that they are all already ongoing between you and the Greek authorities? And the second question is not exactly related to the provisions, but do you plan a revision on the national recovery plans and the distribution of the unused loans? If yes, when? And could you explain a little bit how would you do that? You will take some countries will lose some money, will gain some others. Thank you.
Well, thank you for your question. The compliance with 2% primary surplus target, this kind of recommendation will be considered in our recommendation to different countries that we will present next week. Of course, overall, I can say that Greece, as all the high debt member state, should be very cautious in reducing the level of debt and limiting the nationally financed current expenditure. This is, I think, a principle to consider not only for Greece but for high debt member states in general. As far as the loans component of the RRF and the RRF plans are concerned, well, the RRF plans, we know that discussing are ongoing. Part of this discussion will be finalized through our Repower EU communication that will be presented in Wednesday. And of course, this is connected to some of the features and of the regulation that are linked to the RRF. And then after the end of June, when the final allocation of grants will be established, you know that there is 30% of the grants components that is supposed to be reallocated at the end, by the end of June. After this reallocation, we expect to have several proposals to adjust RRF plans coming from member states, especially those that are having much more or much less, significantly more or significantly less grants. As far as loans, you know that until now we still have more than 200 billion loans non-requested. We also know that there are countries that are willing to make this request. One could be Spain, and it is 70 more or less billion loans. Another one, if and when we will finalize the agreement, could be Poland, and it is, if I remember well, 25 billion loans. So the final amount of non-used loans will not be the more than 200 that we consider now. And let me just remember that the rebus sic stantibus, so with the laws that we have now, the loans requests are legitimate until the end of August of next year. Of course, there is a chance to use what is not optioned by member states, but the process will be, of course, a process taking into account the legal framework.
So I will take a last question from the room, and then I will move to questions from journalists attending remotely.
Thank you very much. Paola Tama from Political Europe. Two quick questions, if I may. One is, why do you expect inflation to peak already this quarter? What are some of the underlying assumptions there, given that you also forecast a tighter labor market? And the second is, if you can elaborate in your no gas scenario, which countries could face a recession? Thanks.
Well, we base our estimate that inflation should peak in the second quarter and then gradually go down, very gradually, and then more substantially next year. This is based on the commodity future curves, mostly. Let me add that the reduction of the inflation rate we are estimating for next year is still, even in the core inflation, keeping a quite high level of inflation. So we are not, because of the extension to other sectors, because of the possibility of second-round effects connected to the purchasing power. So our estimate is, I think, I told in what it's based, but I think it's not a completely optimistic one. So level of inflation for next year is still there. Well, of course, our two different adverse and severe scenarios, they are based mostly on energy, because this is something more solid in a forecast than, for example, the risk connected to duration of the war, escalation of the war, of things like this. That is very difficult to put in a forecast. And of course, these, especially the second one, what we call the severe scenario, is very much connected with the level of dependency of the European countries from Russian gas. And you know very well that more dependent European countries from Russian gas, you know very well who they are.
I will now pass the floor to Rita Siza, who is joining us remotely. Rita, you have the floor. Rita, do go ahead.
Can you hear me?
Yes, we can.
Sorry. Yes, we can. Oh, sorry, and apologies, I have a bad connection. This is Rita Siza with the Portuguese Daily Público. I would like to ask about the figures for Portugal. If you could elaborate a bit on those, because the projection is of a very strong growth in 2022. And I am wondering if it has to do with the fact that maybe the country hasn't recovered so rapidly last year, or if this has to do with the RRF effect. So if you could maybe please give us a little bit more on that. Thank you very much.
Yes. Well, indeed, we have a good forecast both for growth and for the level of debt to GDP, which is set to reach in 23 115%, which is below its pre-pandemic level. I think you are right. There was also a different path in the rebound of the Portuguese economy, not so strong in 2021 in comparison with other countries. And second, I think that the reopening of tourism for a country mostly based on foreign tourism than on internal also played an important role.
I'll now pass the floor to Anne Rovan. Anne, you have the floor. We can't seem to hear you. You may want to change your mic source. No, it's not working. Then we'll try and come back to you later. Then I pass the floor to Mathieu Billon.
Good afternoon. My question is, you mentioned earlier in your press statement that within year growth for 2022 has been cut from 2.1% to 0.8%. If the level of inflation remains high, even if it starts declining, do you think the euro area is heading towards some stagflation? Thank you.
Well, there is, of course, a lot of attention to the word stagflation, so thank you for your question. What we see in our estimates is that we have very high level of inflation, and we have one of the deepest downward for growth in our seasonal forecast. But this is not until now bringing to growth in negative territory. Of course, this is possible if the negative scenario materializes, but this is not our base forecast. So I'm not a strong supporter of the stagflation word because it was used in previous and very different circumstances. But indeed, we have very high inflation and quite low growth.
I now pass the floor to Griselda Pastor. Griselda, you have the floor. Griselda, we can't hear you. You may want to change your mic source. Try one more time. Doesn't seem to work. Are there any further questions from the press room?
My name is Valentina Wisner. I am from Croatian daily newspaper, Večernji List. I would like to ask you if the European Commission has some strategy in struggle with growing inequality, if we keep in mind that salaries are not correlated with inflation.
Big issue, of course, because we are right. The level of indexation is limited among European member states, and in my view, rightly so. But this doesn't mean that we can ignore the fact that in extraordinary circumstances as the one we are in, with this high level of inflation, the losing purchasing power is an issue. I think this issue will be on the policy makers at national levels. There are no EU coordination or harmonization because this is connected to the social dynamics in different member states. What I can say is that, yes, we should take in mind that there is a loss of purchasing power, that we should try to cushion this especially for more vulnerable workers and households. And that we should not forget the fact that this is probably not there to last forever, this kind of high level of inflation. So, again, measures targeted and temporary are justified, in our view.
Now pass the floor to Sander, who's joining us online. Sander, you have the floor. Please, can you change your mic source? Because we're not hearing you at the moment. Okay, well then I will read a question in the chat. So first of all, from Anne Rovan. She's saying that in the Netherlands also the forecasts for 22 are better. So what is the reason for that? Please.
Well, the Netherlands. Well, the forecasts are for the Netherlands. We have a quite high level of inflation, a little bit higher than on the average of the euro area. So it's 7.4% this year in our forecast. We are seeing, I think, important rebound in GDP, driven also, and I think this is important to note, by the government's additional spending plans. So there is a connection with these plans and the fact that GDP is, in any case, forecast to grow, as the deficit also is forecast in 22 to be higher than in 21.
Okay, and then we have one last question, which I will read out from Grisella Pastor. Jusqu'à quand l'Union européenne peut-elle tenir le bras de fer face à la Russie, selon vous, Monsieur le Commissaire?
Bon, jusqu'à quand il sera nécessaire. Je ne crois pas qu'on peut mettre des limites à notre capacité de répondre à une guerre d'invasion. On est, je pense, on connaît très bien les difficultés, on sait que les conséquences économiques sur nos pays, sur nos citoyens, ne sont pas négligeables, mais nous savons très bien que la réponse a été forte, immédiate, et il faut la tenir jusqu'à quand le soutien à l'Ukraine sera capable de mettre les bases pour un accord, pour une négociation entre les parts qui sont en train de mener la guerre. Et alors on ne se donne pas une limite de temps, mais on sait bien que ça ne sera pas facile. Mais je pense qu'on travaillera exactement avec le même esprit de solidarité qu'on a utilisé dans les semaines que nous avons derrière nous.
Many thanks. This brings us to the end of today's press conference. I would like to thank the Commissioner for coming down to the press room and all participants for their questions. Have a nice day.